All right, insiders, today we have a little bit of a holiday special on our hands. I've spent the last 3 hours doing quite a deep dive, and hopefully I can give you this information as quickly as possible where you can walk away with some tangible learnings and maybe even make some adjustments to your portfolio that can add some value. So this is typically what's depicted during a Santa Claus rally or crash discussion. You have the first half of December where there's tax loss harvesting, nothing really new there. And then you have the second half where there's a rally, which comes out to about 79% of the time this works. So that's a pretty big deal. Now let's go over to my deep research here and give you some of the higher level points that you can walk away with for that dinner party flex. So let's see here. The Santa Claus Rally stands as one of the most enduring and statistically significant anomalies in the financial market behavior. I didn't know that, guys. This is a pretty big deal. It's even going back as far as 1970s. It's the final 5 trading days of the calendar year and the first 2 trading days of the new year. So that's a little bit confusing here. You see this huge image, but it's actually just, let's see, 1, 2, 3, 4, 5. These days plus plus 2 in the new year. I'm even in the way right there, but we'll talk about that more in a second. And right now, the big theme for this Santa Claus rally or crash is the Fed, which is getting more dovish, versus tech, which right now is getting exhausted. So it's actually good that the Fed is getting more exhausted. Otherwise, we'd have a double negative probably on our hands. Now, the second thing we're going to talk about is the reverse Santa Claus rally of 2024. It was not very pretty last year. It was a good year, but it ended very negatively, which typically forecasts a little bit of chop and maybe some ominous forthcoming of a year. And that's actually how we started off last year or this year, right? We had that big sell-off during the tariffs. So that's something to keep in mind. Let's keep going here. Talking about the exact statistics here, the last 5 trading days again, and the first 2 trading days, that's very important. So it's not all about December, it's just that 7-day stretch. Now, this is actually one of those parts that I thought, or I really, really liked. Sometimes you have a hunch about these things, but when you read about them like this, it all makes a lot more sense. So the first thing that goes towards the behavioral and structural drivers behind the Santa Claus rally or crash is institutional absence / retail dominance. So let's just read this right here. Hedge fund managers, institutional investors, and senior desk traders typically reduce their activity or vacate their terminals entirely between Christmas and New Year's. Me, as a trader myself, I've been trading for over 8 years professionally, and guess what? I've actually been not trading for just about a week. It's because holidays, and there's just so much going on. There's less volume, there's a lot of chop, so I don't like trading around holidays, specifically the Christmas holidays, and usually I take days off before and after holidays as well. It just is good for my portfolio statistically. That's what Trade Journal tells me. Anyway, this exodus leads to a significantly lower trading volume and reduced liquidity. In this vacuum, the market becomes dominated by retail traders who historically exhibit a persistent long bias. Retail is just a perma bull. I love it. Anyway, this can drive prices higher with thin volume. That's why we trade small caps so much on this channel, because they have a low float and they love to rally. So I loved this analysis right here. It makes tons of sense to me, especially as I've been in the game longer. You know what? It's even funny because now I have a hedge fund and I even feel more of an institutional person myself. Even though I'm very much retail. All right, so tax loss harvesting and the wash sale rule. There's a caveat here that I found really, really interesting. So let's read this. The mechanisms of the U.S. tax code play a vital or pivotal role in the timing of the rally. Taxable investment accounts often engage in tax loss harvesting. You guys probably already know that throughout December. Selling underperforming assets to realize losses that can offset capital gains. That makes total sense. Here comes the interesting part. This selling pressure typically peaks in mid-December. So that's what we were seeing here, peaks in this area. You could even see that dip right here. And where did we, here we go. As the month concludes, this structural selling abates. Furthermore, investors looking to maintain exposure to the sold assets or their proxies must wait 30 days to avoid violating the wash sale rule. Because if you get back into a stock right after you sell it, they're going to cancel that loss out, right? That's why you have to wait 30 days. So what do you do these 30 days with your capital just sitting around? You're not going to just let it sit around. The cash raised, now this is something I often forgot about. The cash raised from these sales is often redeployed immediately into other sectors or broad market indices. Think Russell Index, the Russell 2000, because most people don't want to trade individual stocks. They like these indexes. And we're going to talk a little bit more about the Russell, which is projected to keep on rallying from where it is right now. Let's actually go to the weekly chart. Look at that. All right, going back here, I get so easily carried off. Okay, where are we? But raising cash, often sales, and other sectors. This succession of selling pressure combined with the redeployment of cash creates a natural buoyancy in asset prices during the final weeks of the year. So guys, selling largies, buying small caps for 30 days roughly, maybe longer, and then when large caps go down, they are accumulated again. I love that. Makes tons of sense. I've done it myself, but I never really thought that it was such a big factor. So I love seeing that that this is kind of a macro theme as well. Now, window dressing is something really funny. I do not do this myself because it's irrelevant for me, but I could see a lot of large firms doing this. So for me, it's a big X, but let's talk about it. The phenomenon of window dressing provides another structural tailwind as the fiscal and calendar years close. Mutual fund managers and portfolio managers are incentivized to align their reported holdings with the year's best performing assets. So let's say Tesla's up and your mutual fund doesn't have Tesla. Everyone's going to be like, why the hell don't you have Tesla? So you're going to buy Tesla right at the end just to make your portfolio look like it's doing the right thing. This often involves buying high momentum stocks in the final days of the year to show them off at the balance sheet, signaling to clients that the fund successfully identified the year's winners. This is just total BS, but it is what it is. Simultaneously, managers may sell losing positions to remove them from the reporting period, a process that typically concludes before the final week, leaving only buying pressure for the winners during the Santa Claus Rally window. This actually makes huge buying opportunities for things that have sucked, right? Think like dividend stocks have done pretty terrible on average, but I think 2026 is going to be a booming year for dividend stocks. We'll talk a lot more about that pretty soon. And then the January effect is basically just front running points 1 to 3. So if you're some sort of fund manager or somebody that's been in the business for a long time and you understand point 1, 2, and 3 as a review, you understand institutional abstinence, retail dominance, you understand tax loss harvesting and the wash rule, and you understand window dressing, then you're going to be able to front run some of these typical operations. So that's just basically points 1 through 3 summarized. Now, let's keep going. I love these 4 points, and I felt like this was one of the most important parts of this video, but soon we're going to talk a little bit more statistics and go to the charts too, and that's how we'll wrap it up. So let's see here. 1950 to 2024, correct 79% of the time. This is statistically significant because any other random 7-day period throughout the year only averages around 58% statistically significant results, or statistically unsignificant result, I guess, at that point. So this is pretty much random. This is noise. And then this is how you know that Santa Claus Rally is important. Let's keep going here. We've talked about this. The average return is 1.3% during this 7-day period, which is pretty solid if you think about the SPY over the whole year, which averages around 10-11%. All right, let's keep going. Now, last year was pretty nasty. It declined by 2.4%, even though the whole year was actually pretty strong. The Fed Reserve was very hawkish at the end. You guys probably remember higher for longer, and then people were getting a little bit uneasy about that because they didn't want to lower the rates again, and that's what hurt the rally, the Santa Claus Rally. Now there's a lot of hope for a mean reversion because there's a rally 79% of the time. Last year was negative, so this year, mean reversion wise, should be positive, right? And back-to-back years of negative Santa Claus rallies are statistically very, very rare, occurring only twice in 75 years. So there's a good chance we're going to end strong this year. There's a very good chance we're going to end strong this year. Let's keep going to some more interesting things here. The Fed Reserve policy. Now, that vote to reduce the interest rates was not anonymous. There was a lot of people feeling very different about it. Governor Stephen Moran voted more aggressive, 50 points, but several other people from Chicago, Kansas, wanted to even hold off lowering the rates. So it's very mixed amount of opinions there at the Fed. Now, there will be you'll probably hear this term a lot, QE light, $40 billion of Treasury T-bill purchases. So the Treasury, the Fed is back throwing money into the economy. I guess that is good. Well, it depends. Okay, let's see. The inflation picture is sticky. So it's still sticky, but it's kind of a less of a topic now. Here we go. Inflation as somewhat elevated, but it's not like the main thing. We are now prioritizing the labor market. I think there's enough evidence right now that the labor market is getting very weak. People are very, very nervous about the labor market now that unemployment rose to 4.6. You typically want to see it less than or equal to 4%. Over that typically indicates a recession, very, very bad, and that is why I think on average the Fed has voted to lower it. So weak jobs, more rate cuts. We're talking a little bit here about oil prices. Right now it's around 55, which is actually on the lower end. You want to see a sweet range between 56, 60, depending on who you're asking. If it's higher, it's good for the consumer, but it signals collapsing global demand, which is kind of a recession indicator. So it's like good and bad at the same time. But that's not the focus of this video, really. Let's keep going here. There's a few more points. So the exhausted AI narrative is something we've already talked about. Nvidia, obviously, super, super high. Oracle. Yeah, that's a mess. The AI circle jerk we've talked about in a different video, so it's not a focus here. REITs, oh man, I'm going to make a different video on this topic, so I'm going to fly through it right now. Guys, REITs, hot topic. Small cap, hot topic. Value plays, oh, there's so many good ones. Petroleum, oil prices. Guys, it's going to get really excited. I gotta get on topic here because there's going to be some really, really nice stock picks coming our way, and that's going to be a big focus of 2026. There's so many depreciated stocks that are down 60, 70, 80% because everyone is just looking at the Mag 7. So I think there's going to be a big rotation, and we're going to make a lot more videos on those individual stocks coming up here. So I don't want to spend too much time in this video talking about it. But right now, the scenario is looking to be, conclusion, a rally. And a rally would be a 10% gain roughly in 2026. Although midterm election years tend to be choppy. Keep that in mind. They tend to be choppy, so you got to watch out. But maybe we'll have like a high of 15 or 20% and then maybe average out around 10. I don't know. I'm a little bit pessimistic for the year ahead in terms of just blindly the SPY. The Grinch rally, so here often predicts choppiness or here they say ominous technical signal, so for the year ahead. So they are bullish here. Final verdict favors a rally, so that's good. Some key points to walk away with: 79%, guys, chance of a positive rally, and the average is 1.3%. Last year was negative, but I don't think we're going to see that this year. You never know, could happen, but the double negative is very rare. Now, there are some very, very key support levels they talk about. The 6.7, 60, 670, 80, and then here at the highs for a breakout, 6.870, and then 6.9. Let's go to the charts really quickly and look at that. So that is roughly, here's the support zone. We're right around the 50 SMA, simple moving average. We want to maintain this and break higher. And this is the point that we want to break out of. So that those are the key ranges that they talk about, which are pretty easy to map out. I mean, we have retests and rejections there. So very, very clear lines. I just used exactly what the research report said and put them on the chart for you guys. And last year, I also want to talk about the last year's Santa rally really quickly. So that was these 5 trading days, 1, 2, 3, 4, 5 of the last year, or of the 2024, and then into this year 1, 2. Now this looks pretty bad. They used 2.4% down because I think they used the close That's what I think they did, which was somewhere, yeah, 2.4. That would be this down here. That would be from like here to here. But if you really think about it, the open to the close, it wasn't that bad. It was like 0.7. But, so it was red, yeah, but it wasn't really that bad. But yeah, it definitely fell off a cliff there for the Santa Claus rally. Probably put a lot of people on edge. So those are the main takeaways. Let me know in the comments, guys, what you guys feel about this Santa Claus rally. Are you a bull or are you bear?